Okay. Okay. What is the ultimate aim of every organization? What is the ultimate aim of every profit-making organization? So let me make it profit-making organization. Okay. What is the ultimate aim of every profit-making organization?
Yes, to maximize profit and minimize cost.
Okay. So the ultimate aim is to make profits. After this particular aim has been achieved, what do you think they will be thinking about again? What will be their next move or what will be their next target? If you are only in Kumasi and you are making profit, will you be in Kumasi forever?
No.
Okay. They will want to what? They want to have what? Uh, they want to have presence in what? In certain jurisdictions. Okay. And that is what we are coming to look at now. Okay. So a company will be in a particular jurisdiction and they have now realized that okay, they have conquered that particular jurisdiction. So they will feel like what they want to have presence in what? In other jurisdictions. Okay. Having that particular presence can be achieved in so many ways. Okay. But we are going to be looking at only one of them as far as consolidation and business combination is concerned. It's only one of the means of what? Of having a presence in other jurisdictions that is what we are going to be looking at. We are going to be looking at the one that there will be an outflow of what? Resources to what? To have that particular presence. That's what we are coming to look at. Okay. So the entity, after fulfilling that aim of making profit, they will no like to what? To be at only one, to be at a particular place forever. They will want to have presence. If they are in Kumasi, they would like to have presence in Accra. They would like to have presence in Northern region. They would like to have presence in Volta region. Okay. They will want to what? Expand their what? Their market share. Okay. So they cannot be at what? Kumasi forever. No. Okay, so after the profit has been achieved, they will not think about expansion. Okay, this expansion that we are coming to look at right now, the expansion can come in what? In so many ways. Okay, so the form of what? Expansion, okay, the forms of expansion can be in so many ways, or they can achieve the expansion in so many ways. Okay, the first one is that they can do what we call a merger. Okay, they can merge with what? With a company that is already operating in that particular area. So they can do merger. Okay, they can do merger. That will also be a form of expansion. Okay, they can also do what we call takeover. Okay, they can also do what we call a takeover. So they can actually take over another what? Another organization. So you can mostly the government organizations, most of them they will not be doing well. So they will now invite private individuals to come and run them. So they will take over from the government. It doesn't mean that the company does not belong to government, but now the management that will be there will be what? Will be from the private individuals. They will be running it for the government now. They can also do, you can also do this particular one through what we call inheritance. Okay. So you have your what? You have the you have you you have your own organization. Okay, you have your own organization in Kumasi, but your dad is having another one in Accra. But the company has uh the company has been willed into your name or whatever is going to be happening after your dad is no more. You are the one who is going to be taking over the company. So you can see that if your dad is no more, you are going to be hearing that. Okay, probably you'll be changing the name to your own company. Okay, that is also you are expanding your operations now. You will now be taking your goods to that place to sell. Okay, but the most important one, the expansion can be what we call acquisition, and this is what we are coming to look at. Okay, this can be through what we call acquisition. So this is a portion that we are coming to account for. Okay, we are going to be accounting for that particular expansion that involves what? Outflow of what? Economic resources. Okay, before you can have access to the net asset or assets of the entity, you need to pay for what? For whatever you are buying. That's what we are coming to look at. So this can be done through acquisition. What do you mean by acquisition? What do we mean by acquisition? The acquisition means that you are going to be buying the net asset of what? Of the company. You are going to pay for whatever you are buying. So if a company is in Ghana, we have uh Telecel. They are now saying that their name is Telecel. Okay. So you have Telecel in Ghana. They want to have presence in Nigeria. Okay. Let's say that there is what? There is a telecommunication what entity in Nigeria that Telecel want to have presence over there, but they don't want to go there and do everything themselves. They don't want to go there, rent an apartment, bring their machines there. Okay, they want to make the process very fast. So they are going to acquire what? They are going to acquire the telecommunication company in Nigeria. If they do so, they are going to have presence now in Nigeria. Okay, they are going to have presence in Nigeria. They can actually ask the entity to maintain their name, or they can now change the name to Telecel Nigeria. It depends on whatever they want to do. But if the entity is going to be keeping their name, they will be selling the Telecel what? SIM cards to those people. Okay, or they can allow those people also to be selling their own thing, but just that Telecel is now the owner of that particular organization or majority owner of that organization. So the form of expansion that we are going to be looking at under or based on our discussion is going to be the one that is through acquisition. Okay, we are saying that in business we record transactions that are having what? Monetary values. Okay, we record transactions that are having monetary values. We record transactions that we can determine their cost reliably. So if someone is giving something to you, for you to determine that particular cost of that particular item, it's going to be very difficult for you. So if you actually pay 10,000 for something, we know that is the cost, so we can measure it. So we are coming to the accounting. So we are going to be looking at accounting for this one, which is the acquisition. Okay, so we'll be using the acquisition method. That is basically whatever we are coming to do. Okay, so we are saying that the entity would like to expand and they would like to acquire. If you are going to acquire, who are the owners of a company? Who are the owners of a company?
Shareholders.
We have so many shareholders. So which of them are you talking about?
Ordinary shareholders.
Okay, so the ordinary shareholders are the owners of the company. So if you want to expand by acquisition, it means that you are going to be acquiring what? If you want to be the owner of a company, it means that you have to acquire which type of shares?
Equity.
Ordinary.
Ordinary
Okay.
shares.
You have to acquire the ordinary shares. Those are the people that are having the ownership rights of the entity. So if you want to expand, you are going to be buying the ordinary shares of the company. Okay, before we start, please, I want to tell you the only share, okay, the only share that will give you ownership is ordinary shares. The only share that you are going to invest in that is going to give you a form of ownership is ordinary shares. The question will be telling that the entity has also invested in the preference shares. Please, preference shares are treated as what? Are debt instrument. Preference shares of any form, either it is redeemable or irredeemable. Preference shares does not give ownership. So if you are talking about ownership over here, if an entity invests in what? In preference shares of what? Of a company, the company, that particular person or that particular company has no right to what? Ownership. Okay, so the acquisition that we are going to be talking about over here, you want to have ownership or you have to have ownership of, if you want to have ownership of an organization, you have to invest in their what? In their equity shares, which is what we call the ordinary shares. So the acquisition over here is going to be the acquisition of what? Ordinary shares. If the company invests in what? In loan instruments or in a debt instrument, that is not what? That is not a form of what? Acquisition as far as what the standards that we are going to be using is concerned. Okay, so we are going to be looking at a company investing in the what? In the ordinary shares. Okay, if you are investing in the ordinary shares, some of the people can invest based on their what? Based on their capacity. So someone can say that I'm going to be buying only 10% of what? Only 10% of the ordinary shares. Someone can say I'll buy 25% of the ordinary shares. Someone will say, okay, I'll buy 65% of the ordinary shares. Okay, you can see that they are all having a different level of ownership, isn't it? Different level of ownership. If this acquisition is done, okay, they are going to be paying money. How do we account for it? We are going to be looking at this, okay. But what are the standards that we are going to be using for the group accounts? Okay, for business combination of group accounts, what are the standards that we are going to be using? Okay, or what are the standards that we are going to be applying when we are doing this one? We are going to be applying the IFRS 3, which is a business combinations. Okay, a business combination is what? Putting two business together. Okay, two business are now combined together. That is all, or two or more business are now put together. So we are combining the business. Okay. Okay. And the business combination will only occur when a control is what is obtained. Okay. If you say business combination, it means that A and B are combining their operations together. And for that reason, they are what? They are preparing what? A single financial statement. When will you do that? Okay. When will you do that? Okay, when will you do that? That is what we are coming to look at. Okay, and the business, we say business combinations can be achieved in so many ways, but the one that we are going to be talking about is what? Is the acquisition. Okay, you can do merger and you combine Tigo. You can see that they are now combining what? Two business together as one, Tigo. Okay, there can also be a takeover. The takeover, if you are doing takeover, you also prepare the financial statement for the two entities. You can also do inheritance. The inheritance, you are now the owner, plus your own business. That is it. You can also do acquisition. You are now the owner of that particular company, plus your own business. So you have to prepare a statement for the two. You are now combining the two. But we say that the business combination will be only the acquisition. Okay. Then we also be looking at what we call the IFRS what? Third. Okay. Which is going to be looking at what we call the consolidated what? Financial statements. Okay, consolidated financial statements. Okay, so we have the consolidated financial statements. Okay, a company who has control over another company is required to prepare a consolidated financial statement. What do we mean by consolidated financial statement? We are talking about preparing financial statement of two or more entities or one or more entities as if they are a single economic entity. So we'll be looking at consolidated financial statements. Okay. So we also be looking at what? The IFRS 13, which is fair value measurement. So we'll be looking at fair value measurement. Then we'll be looking at the IAS 28, investment in associates. Okay. The investment in associates also will come there. So we have the investment in associates. We have the IFRS what? IFRS 11, which is what we call the joint arrangement. Okay. So the joint arrangement can result in joint control or joint venture. So we have two types of what? These arrangements that will have a situation of what? Joint venture or a joint control. So two companies, we are two different companies. So we want to now carry out what? A particular activity. We know that we don't have the capacity to do it on our own. So what we can do is that we can go into a partnership with what? With another organization to do that. But we are not going to be doing this in our own capacity. If I say in our own capacity means that we are not going to be using our existing what companies or our existing firms to do that. We want to establish a new firm to do that. After that particular one, then we dissolve that particular firm. So we are going to be forming a joint venture. How do we account for it? Or we can say that, okay, we are going to be buying, we are not going to be forming a new what? A new entity, but we are going to be buying new what? New equipment, which we are going to be using for that particular arrangement. So that I can be using my existing what? Capacity, or I can buy a new capacity now, or a new asset that will be used for that particular one. But we are not going to be what? We are not going to be forming a new what? A new organization. And that's what we call the what? The joint control. Okay. So we have the joint venture or the joint control. How do we account for that one? We'll be looking at, mostly this is for corporate reporting side. So we'll be looking at that one also. Then we also look at what we call the separate financial statements. Okay. Okay, so we'll also be looking at the 27, the separate financial statements. That is not going to be having a major issue on this one, separate financial statements. Okay. The entity, they are going to be preparing their own separate financial statements, and how certain items will be included in their financial statement will be different from when we come to the consolidated group account. So this is what we are going to be looking at. Okay, this is what we are going to be using these standards in preparation of what the consolidated statement of financial position. So we have business combination. So we'll be looking at this one, this, and this. Maybe sometimes they can give you a question that will be involving this one also. So we'll be looking at this few of them. Okay, we have just agreed that if you want to obtain ownership over a certain organization, you are going to be using what we call you are going to be acquiring what we call the equity shares. You are going to be acquiring what we call equity shares. Okay, if you are going to acquiring what we call equity shares, it means that you might be acquiring a business. Okay, you might be acquiring a business. Why do you mean by you are acquiring a business? The business is owned by the what? By the equity shareholders. So if you acquire the equity shares, it means that you are going to be acquiring what? A business. Okay, they can give you a question that they will ask whether the entity has acquired a business or they have acquired a group of assets. Okay, how do you determine that? We'll be looking at that also, whether this is a business or whether this is what? This is just a group of assets that you are acquiring. Okay, whether that is a group of assets that you are acquiring. Okay, let's come to the issue. Okay, so we are saying that if the entity acquire 10%, how should they account for that particular one? So if you acquire equity shares, okay, equity shares of 10%. If you acquire 10%, it means that there's a 90% shareholding over there which has not been acquired, isn't it? If you acquire equity shares of 10%, okay, it means that 90% is there and you have now acquired it. Can you say you are the owner of the what? Of that particular company?
No, sir.
No, sir.
Okay. So let me just make it simple. Acquisition of equity shares from 10%, okay, from the range of, okay, let me just say not from the range of what? Acquisition of equity shares within the range of 0% to 20%, okay. If you acquire this one, someone can be having a holding of 70%, okay. It means that this person is the what? Is the owner. Okay, you are having 70% of that. It means that you are the owner of that organization. So the person will be claiming the ownership of that because your 30%, the remaining 30% cannot do anything. Okay, so this person will be seen in substance as the what? As the owner of what? Of the organization. So if you have investment in equity shares, which is from the what? Within the range of 0% to 20%, please. This is what we call a normal investment. So you'll be accounting for this as a normal investment where you are going to be using the provisions of what? IFRS what? 9, financial instruments. Okay. So you account for this one as a normal investment. This will not give you a significant influence, and this will not even give you what? This one, if people want to take decision, you have 10%, they will not even mind you. Okay, you don't have a say. The say that we are talking about is a significant influence. So you can also influence what? The decisions that the majority owners will be making. Because if you have 40%, okay, that 40% you can combine with some people that are having, let's say, 5%. You can combine with them, you can have a say on a particular issue. Okay, so you have a significant influence over that one. But from 0 to that one, if you have 5%. Some of us, we have invested in the MTN. Okay, the MTN, the time that they want to go public for the first time, they were issuing shares to what? To their mobile money, what? Mobile money platform. Okay, some of you that we have, let's say 0.1%. Whenever they are going to have a general meeting or annual general meeting, have you been given a notice before?
I don't think so.
It means that your investments are nothing. Okay, that is what we are talking about over here. So if you have that will be treated as a main investment. Okay, they will just send you a message that they have declared dividends of this is your portion. That is it. You don't have any say because your investment does not count. But if you should be having 35% of their ownership, they will give you notice that okay, we are going to be having a general meeting, so your representative to come or something like that. It means that you have a say. Whatever they are going to be doing, you have a say over there because your shareholding is what is giving something. You have a say in whatever they are going to be doing. But if their holding is 0 to what? Within the range of 0, between the range of what? 0 to 20, you have only a normal or a mere investment, which you are going to be classifying as either a financial asset. So this will be true equity. Okay, this will be true equity. So you have financial assets, which will be true fair value or other comprehensive income. So if it is equity shares, we have only 2 classifications. Okay, if it is financial assets acquired through equity, you either classify this particular investment as financial asset through fair value or other comprehensive income. Okay, but the question is, if you have from 20, if the investment is from, okay, if the investment is within the range of 20 to, let's say, 20, let me just make it 49 so that we not get it what twisted or complicated. So let's see 49.9 or 49.99%. Okay, we don't do approximation for ownership. So let's say within 20 to 29. Okay, if you are having, let's say that the MTN, you are having 35% ownership. If they are doing general meeting, would they inform you or they will not inform you?
They will.
They will. Okay. So if the investor, okay, if the investor is having more than 20% but less than 50% ownership, we say that that particular person has particular say, which we call the person has a significant what influence. Okay. Whatever decision that the majority will be taking, you can actually challenge it. Okay. You can also, maybe they will not take what you are taking into consideration, but they will consider what you are saying. Okay, they will be considering what you are saying because if you have 35% and the 65%, the person with the 65% want to take decisions. Okay, the person will not just go there and take decisions. The person will actually inform you. Although the decision that he's going to be taking, maybe he is the majority holder, he will still take it. But he will consider what you are going to be doing. So he will not take decisions that is going to affect you because he knows that if he takes decisions, which are not going to be in your favor, you can actually take your investment back, and that is going to be affecting the organization. Okay, so if you have issues like this, we say that you have what we call a significant influence. Okay. You have what we call a significant influence. Okay, we are going to be looking at what are the indicators of significant influence, which they can ask you. Okay, which they can ask you in financial reporting. Okay, so let's come to the investment which will be above what? Investment which is going to be above what? 50%. Okay. So let's say you have what? You have 60% ownership in the organization. Can we say indirectly you are the owner of the what? Of the company? If you have an organization that you have 100% first, but you have decided to sell 40%, will you be saying that you have lost ownership over that particular organization?
No, sir.
Okay, you are still the what? The owner, the majority shareholder. Okay, so if you have this particular one which is above 50, you have what we call a control. You have control. What do we call control? Basically, control is where you have more than 55% of the majority of the what? Of the ordinary shareholding. Okay, you have at least 50% of the ordinary shareholding or 50% interest in the ordinary shareholding of an organization. That's what we say we have control. However, you can have less than 50%. You can have 40% and still have control. Okay, what do we mean by you can have what? 40%. Basically, if you say there's a control in your exams, okay, they will give you a control. They will just give you a shareholding. The entity or the investor has acquired a particular shareholding. That is going to be, if you calculate it, the percentage of what the holding will be what will be more than 50. That means that the person is having control. But it can give you, let's say, 45% ownership or 40% ownership, and they will give you certain information to tell you that, okay, although the person is having less than 50%, the person still have what? A control over that particular organization. So control doesn't mean it should be above 50. You can still have less than 50, which can be 40, 35, but you still be having control. Where would that particular situation be? Okay, we are going to be looking at that. You can have 40%. Okay, you can have 40%. Okay, but the remaining 60%, the reason why we are saying that if you have 40% is a significant influence is that we assume that the 60% is being owned by one person. Okay, that's what we see from 20 to that one is what is a significant influence, because the assumption is that the remaining 60 is owned by only one investment company or only one private organization. Okay, so it is being owned by only one investor. Okay, that's why we are saying that the 40 is a significant influence, because this person will be claiming, the person who is having the 60% ownership will be claiming the ownership over the organization. But what if this 60%, what if this particular 60% is being spread among 30 people? One person will be having what? If
2%.
Okay, this 2%. If we count to meeting, if all of you are voting independently, okay, if they say you are voting independently, that your vote, if you are voting for yourself, you cannot combine your forces with one person to vote. Okay, if these people are voting independently, who is going to be having majority of the vote? If you are voting independently,
The one with 40.
the one with the 40. So the question will tell you that the entity, the shareholders, or the remaining 60% has been spread among what? Numerous shareholders who vote what? Independently. Okay, in this case, it means that if you count to voting, you are going to be having a higher of the voting right than these people. So in this case, this will also be giving you a control. You have control over the what? Over the board. So the question will be giving you, if they are giving you less than 50, they will provide you with the information that will be telling you that, okay, although it's 40%, this particular one is still having what? Control. They can also tell you that the entity has the power to appoint or remove what? Major or key management personnel from the board. Okay, the entity has the power, okay, or has the right to appoint or withdraw or remove key management personnel from the board of directors or from the board of the organization. If you cannot remove anybody, if you are not the majority owner or if you don't have control over that particular organization, it is the majority shareholders that are going to be appointing people onto the board, and those are not going to be appointing. So if they say the entity has the power or the right to remove or appoint, it means that they have control over that particular organization. Okay, they can also tell you that we have 60% over here, and this one, the remaining 60% is spread over numerous people. It means that you are going to be having majority of the votes. Okay, so you have control. They can also tell you that the entity share a key management personnel with the investee. What do we mean by the entity shares a key management personnel with the investee? We can have the CFO. Okay, the CFO of let's say A. This is the B. Okay, this is the B. The B is the company that we are having 60%. Okay, So we are having 40%. Okay, they will say that A and B shares what a key management personnel. What it means is that the CFO of A is the same as the CFO for the what? For the B. So the CFO is doing two jobs at the same time. Okay. When can you share, or when are you going to be sharing what? Your staff with what? With a different organization. When? When can you do that? When will you be doing that? Can you share your CFO with an organization that you don't have any relationship with them?
Say no.
No, please.
Okay. Can you share if we have, okay, you can see that MTN, they are going to be having a CFO that is going to be a group CFO. So the MTN Nigeria, MTN South Africa is the same CFO that is going to be what? That is going to be what? Overseeing their financials. Okay. If they say that A is sharing a key management personnel, it can be CFO or the chief operating officer. You can only do this if you have control or if you are the owner of that particular organization. So the CFO over here will be seen as a group CFO. So he is going to be overseeing the operations of all the subsidiaries of that particular organization. So they will say that the CFO, the entity shares a key management personnel with what? With the investee. Okay. It means that they have control. You cannot share if you don't have control. You cannot share a key management personnel with somebody, or you cannot allow your staff to oversee the operations of another organization if you are not the owner or if you don't have control over that particular organization. They can also tell you that the entity has the power to what? To direct which entity that they should go into transaction with. They can actually remove what? The entity from dealing with what? A particular supplier. You can only do that when you have a control. Okay, so we'll be looking at the indications of what? Significant influence, indication of control, where you'll be having 40%, but you still have control. We'll be looking at those ones shortly. Okay, but you have to know that from the range of 0 to 20 is a normal investment that should be accounted for as a financial asset in accordance with financial instrument. But if you have from within the range of 20 to 49.99%, we use what we call the IS28, which we call the investment in associates. You are having a significant influence, and that should be accounted for as investment in what? In associates. Okay. Let's come to what we call a business. We are saying that you should acquire a business. Okay, you should acquire what? A business. So let's come to what we call okay, before that, let's move on to the issues of the significant influence over there. Okay, so we are saying that the relationship, okay, the relationship, if you have 20 to 20%, you have what we call the investor. Okay, we have what we call the investor and the investee relationship, where the investor will be classifying the investee as an associate. Okay, so as an associate. Okay, so you will see that Kofi and Amma associate. It means that the shareholding that Amma is having is not what? It's not more than 50%. So Kofi is actually the majority shareholder over there. So Amma is just seen as what? As an associate. Okay, so we have investor. Okay, some people will call it parent associate relationship. Okay, but you can have the investor and the associate. We only have a parent when there is a control. Okay, if the control is if the holding in the equity shares, again, the only shares that will give ownership is the equity shareholding. Okay, if there is an investment in preference shares, please, we are going to be looking at how we account for that. That does not give ownership. Okay, so if you want to determine the percentage of control or the percentage of ownership, you just take what? The total ownership and the portion that you are buying. You strike it and get your percentage. Okay. Investment in preference shares of any form does not give ownership. Investment in what? Debt instrument does not give ownership, because debt instrument itself does not give what? Ownership. The only class of shares that will give you ownership is the equity shares, the ordinary shares. So if you want to obtain ownership over the company, it means that you have to buy the shares from the owners, and the owners are going to be the equity shareholders. Okay, so if you have the relationship over here where we have, okay, so where we have we have above 50%, we have control, and the relationship over here will be the parent subsidiary relationship. The parent is the what? Is the one obtaining control over, or the parent is the entity or is the organization that is buying what? More than what? The 50%. And the subsidiary is the one that the parent is buying more than, is the entity that the parent is buying more than 50% of each shareholding. Okay, let's come here. We are talking about control. Okay, we are talking about control. Okay, when do we say the entity has what? Control. You can only have control when you acquire what? Majority of the shareholding, basically more than what? 50%. Okay, more than 50%. Okay, that is where you have control. And if you have control, what do? You are the owner of that particular company. So if you are preparing financial statements, you have to prepare the statement for all the companies that you have owned. You have to combine, because you are one company, although they are in different jurisdictions, but you are the owner. So if you are preparing statement, you have to prepare a statement for yourself, which is going to be all the entities that you have. So we call something the group account or the consolidated financial statement account. So if you have control, you consolidate what? The subsidiary, because the subsidiary is now seen as what? As one of your companies. Okay, when do we say there is a control? The first one is when we have what? Power over the what? When the investor has power over the investee. Okay, when the investor has power over the investee. When can we say they have power? Okay, when they have power, but we are saying that basically it is when you have majority of the shareholding. But you can have less than majority of the shareholding, but you can also be having control. How can this happen? You have power over the what? Over the investee. You have power over the what? Over the investee. Power can be, you have the right, okay, you have the right to remove, okay, you have the right to remove or appoint what? Key management what? Personnel on the what? On the board of the organization. Let me just share this thing. The notes, I will be adding certain things. So when I'm done, I will share with you. Okay, I saw someone talking about the notes there. So I will be adding a lot of things now. So when I'm done, I will share that one with you. Okay, so let's come to the control. Okay, when do we say we have control? When there is a control, the investor is there. The investor then is referred to as parent or a holding company, and the investee is a subsidiary. Control in most cases involve the holding company or parent owning a majority or greater than 50% of the ordinary shares in the subsidiary, to which normal voting rights are attached. There are circumstances, however, when the parent may own only a majority of the voting power in the subsidiary, but the parent still has control. Okay, this is what the standard is saying. The IFRS 10 is saying about this one. Okay, provide a definition of control and identify three separate elements of what? Control. When the investor has what? Power. When do you have power? You have the right to what? You have the right to remove. You have the right to tell the organization which people that they should transact business with, and you have the right to share your key management personnel with them or everything. Okay, so the first one is that control will be when they have power over the investee. Okay, exposure to or right to a variable return from its involvement with the what? With the investee. Okay, exposure to or right to variable returns from its involvement with the what? With the investee. Okay, what are we talking about? We are talking about exposure or right to variable returns from its investment with the investee. What we are trying to talk about over here, the variable return is what? Is the share of the profit. Okay, the share of the profit, because it's the profit that is going to be what? That is going to be variable. Profit will not be fixed, but dividend can be fixed. Okay, dividend payment can be fixed. So the dividends, even if you are mere investor, like you are having 10%, you will still be entitled to dividends. Okay, so if you are main investor, you are going to be having an entitlement to only the dividend. You are not going to be having any share of the profit. Okay, but we are talking about variable returns over here. Variable returns, we are talking about a profit. It is a profit that is going to be variable. It is a profit that is going to be changing. So if you have a share of their profits, then it means that you have control over them. But if you don't have control, you'll be having only what? Only the return, which is the investment over there. Okay, so there you have the exposure to the right. You have the ability to use its power over the investee to affect the amount of what the investors what return. Okay, so what we are saying over here is that the entity has the power to tell them what the portion that they should pay as dividends. So they have the power to determine the dividend payout ratio. Okay, if an entity can determine the dividend payout ratio, then it means that you have control over them. So they can tell the management of that particular company how much should be paid as dividends. Okay, how much should be paid as dividends, or how much should not be paid as what? We should not pay dividends at all. So they can dictate to them, they can tell them, don't pay any dividends, and you will not pay dividends. Okay, that is the power that they are talking about over here. So we are saying that ordinarily control is what is achieved when you have 50 and above, or more than 50% of the what of the ordinary shareholding. But you might be having less than 50, but you still be having control. And that particular one will be achieved in this situation. You have power over the investee, you have the exposure to or the right to the variable returns from its involvement with the investee. You have the ability to use its power over the investee to affect the amount of investors what return. Okay, let's come to when do we say you have power? Okay, when do we say you have what? Power. When do you say you have what? Power. Okay, when do we say we have power? Okay, if there are changes to one of these three elements of control, then the investor has to reassess whether it controls an investee. So if they are saying that there's any changes in any of those things that we have looked at right now, they have to reassess. But when do we say we have power? Existing rider give the current ability to direct the relevant activities of the investee. Okay. Then we have power can be obtained directly from ownership of the majority of the share voting right, or can be derived from other rights such as, so if you have majority of the voting right, that is giving you power, and the majority will be where you have majority of the shareholding. But you have the right to appoint or reassign or remove key management personnel who can direct the relevant activities. So I'm saying that if the question is giving 40%, they will give you information to tell you whether there's a control or there's no control. But if they just give you 40%, it means that will be a significant influence. Okay, so they have the right to appoint or reassign or remove key management personnel who can direct the relevant activities. You cannot remove the CFO if you are not the owner of the company, or you are not the majority owner, or you don't have control over that particular organization. Right to appoint or remove another entity that direct the relevant activities. So if we have auditors now, okay, if we have the auditors now, okay, the auditor for the organization is Deloitte, okay, but now they want to remove that. They want to end the contract with Deloitte and have let's say PwC. Okay, it is the company that is having a 40% that is now appointing the new auditors now. You cannot do that. You cannot just stand up and appoint auditors if you don't have control, or if you are not the owner of the organization. Okay, they also have the right to direct the investee to enter into or veto changes to transactions for the benefit of the investor. So they can actually dictate to you who you should transact business with, the kind of investment that you should undertake, so that it will benefit the investors. So if the management want to invest in the shareholding or in the investment of Men's Good, the entity can tell them, don't go there. Okay, don't go there. Go and invest Go and invest in this particular investment. Okay, so they can tell you the kind of investment, the person that you should do business with, the kind of suppliers that you should take goods from, and the kind of things that you should do that will benefit the investors. Okay, other rights such as those specified in management contract, other rights such as those specified in in management contract. So in the management contract or in the contract that has been signed, they can say that you are going to be having, let's say, although you are having 40%, but if you count to issues of voting, you are going to be voting as if you have 60% what shareholding. Okay, that is also going to be an issue. Or there can be other issues that will be indicating control, other issues that will be indicating control in that particular regard. Okay, in that particular regard. Let's come to what we call significant what? Influence. Significant influence. Okay. Significant influence, you don't have control, you don't have power over the organization, but you can what? You can actually take part in their policy making, in their financial, those things making, but you cannot tell them what they should do. But you also have a say when it comes to what? Policy developing and other issues. So we say that there's a significant influence. There's a significant influence when the power to participate in the financial, when the entity has the power to participate in the financial and operating policy decisions of an investee, but is not control or joint control over those policies. Okay. We have what we call joint control also. So they can give you a question where the two organizations will be having 50-50. Okay, the two organizations will be having 50-50. The question now is who is going to be preparing the consolidated financial statement? What you do is that you just have the share of all those things. You are going to be consolidating. If the two of us, if no organization has been appointed to consolidate among the two, if none of them have been appointed to prepare the consolidated financial statement, what we do is that we share the holding. I will present 50% of everything that the subsidiary is having, 50% of the profit, 50% of the liabilities, 50% of the assets, 50% of everything that they have. So add it to my items, 50% of their everything to my assets and liability, 50% of their revenue or their profit or loss items. I will add it to my profit or loss items also. Okay. We are saying that significant influence is where they are having 20% or more, but less than 50%. Okay. When do we say there's a significant influence? When do we say there is a significant influence? You have a representation on the board of directors, okay, or equivalent of the investee. So what happens is that the board of directors that you also have a representation over there. Okay, you are having 5% in MTN, 5% of the shareholding in MTN. Nobody reach out to you that you should bring a representative on the board because you are having a significant investment over there, which is 35%. If they should just take any decision without your notice, it's going to affect you. If something happened to the company now, it is going to be affecting the investment that you have over there because the investment over here is kind of significant. So you should have people on the board who also have say on whatever they are going to be saying. Although they are not going to be changing what we'll be saying, but they will also contribute to whatever they are going to be saying over there. They will also contribute to whatever they are saying over there. So if you have a representation on the board of directors, it means that you have a significant influence over that particular one. You also participate in the policy making process. So if they are going to be making policy, any policy that they are going to be making, you are going to be involved. Okay, you are going to be involved. You not just be there, then they will make policies and say, oh, these are the new policies now. No. If the policy is going to affect your investment because you have a significant investment. Okay, so they cannot just do things, although you are not owner, but they cannot just do things leaving you in the dark. Okay, but you that you are having 2% in MTN, they can do things even without you. They can even sell your shareholding without you knowing because 2%, what is 2%? Okay, so they can also have material transactions between investor and investee. Okay, we have material transactions between what we call the material transaction. They have been carrying out a transaction that is involving a huge amount of money. So the transactions between them, they give loan to themselves. The loan is a huge amount of money. They also sell among themselves, and the sales is it's not just you sell 10,000 worth of goods to somebody. No, the volume is of the sales is actually material. You cannot be selling to somebody on credit. Okay, to the tune of what 10 billion if you don't have any relationship with the person. So there are a lot of transactions between them. That is material. It can be credit transaction or cash transactions. You cannot sell to that particular person if you don't have that relationship with the person. You cannot grant a credit facility of 10 billion to someone that you don't have any relationship with. So there's a material transaction between them. There is an interchange of management personnel. We are not saying that they are sharing. Sharing will be a form of power. Okay, but the interchange, you are giving me your CFO, I'm giving me my CFO. We are now I'm giving you my accountant or my senior accountant. You are also giving me your senior IT person. That is an interchange. We are not sharing. Sharing will come in as a form of power. Okay, so there's an interchange over there, and there's also a provision of essential technical information. So what will happen is that if they need any information as to IT and whatever they want to do, we are the one providing them with those technical information. Okay, I will not be going into the consolidated financial statement now, but we'll be looking at the issues of the business combination, which will be looking at the IFRS 3 business combination. Okay, so that's what I'm saying, that I'll be adding a lot of things to the lecture notes. Okay, you have to know that the kind of acquisition we are going to be looking at over here, or the kind of expansion that we are going to be looking at over here, is the acquisition. So we use what we call the acquisition method. Okay, the question can ask you, why is it important to identify acquirer of an organization or acquirer in a business combination? Why? State 3 situation where it will be very difficult to identify acquirer in business combination. We are saying that the acquisition, the business combination, or the business combination that we are going to be talking about is the one that there will be an exchange. Okay, there will be an exchange. The exchange means that you are going to be paying for whatever investment that you are making. You are going to be paying. You can pay in kind, you can pay in cash. Okay, we are saying that it should be acquisition. It should be acquisition. Acquisition means that you should acquire the net asset of that particular entity. Okay, you have to buy because before you can become part of the owners or the majority holder, or before you can become a majority shareholder of the company, you have to acquire, you have to pay for their shares. You have to pay for their shares. Okay, that's what we are calling the acquisition method. Okay, another acquisition method, the question can ask you, why is it important to identify or state the conditions that is going to make it very important for you to identify acquirer in business combination? If you come to the acquisition method, we have 4 things to look at. We have to come to identifying or identification of the acquirer. Okay, we should be able to identify the acquirer. Acquirer is the company that is buying the equity share holding of the acquiree, okay, or the investor. Okay, we also identify the acquisition date, very important. Okay, identification of the acquisition date. Okay, identification of acquisition date, that is also going to be very important, and that is why if you are preparing your statement of financial position, you put your acquisition date there. Okay, the date of acquisition and identification of the acquisition date. Okay, identification of the acquisition date. Then you also identify and measure. Okay, the measurement is going to be very simple. You identify, identification and measurement of what? Of the assets and liabilities, and the minority interest, which we call the non-controlling interest of the acquiree. The measurement, very important. The measurement is very important. It is the measurement that we use the fair value there. Okay. Then the last one, you should recognize any goodwill. Okay. You should recognize any goodwill arising from From the acquisition. So we are going to be looking at that now. Okay. The question was, they can ask you, why is it important or why is it difficult to sometimes identify the acquirer in business combination. Okay. You can only identify acquirer when there's what? When there's an exchange. Okay. When A is paying for the shareholding of B, you can identify A to be the acquirer, isn't it? When A is buying the shares of B, you can identify A to be the acquirer of what? Of B. Is that the case?
Yeah.
Okay. Etetigo, who is the acquirer? Etetigo, who is the acquirer?
Vertigo is merged.
Vertigo.
No?
Okay, Etetigo. Can we say someone is Airtel is acquiring Tigo or Tigo is acquiring Airtel?
No, please.
Okay. So one of the conditions that can make it very difficult for you to identify acquirer in business combination is what? Is the merger. Okay, we can combine business by merging. We can combine two business by merging. So if you are merging, we cannot identify who the acquirer is. So one of them is is the merger. We also have takeover. Takeover that is not involving any transfer of cash or any transfer of any item in kind. Okay, you can see that those days GCB want to take over certain banks. I don't know whether you have heard about those news. Okay, GCB want to take over certain banks because they are not doing well. Okay, GCB is not going to be paying anything, but they are going to be running the banks for the owners. They are not going to be paying anything. So takeover involving takeover that does not involve any payment for the net assets. So takeover can also present a situation where we cannot identify the acquirer. Acquirer, there should be There should be a transaction. There should be a transaction involving exchange. You are paying something, whatever you are doing, you are paying something for it. There can also be an issue of inheritance. Okay, if you have an organization, your dad also has one, and your dad is no more. That particular organization has now become yours. Okay, if you want to prepare your statement, you are going to combine the two entities together. You are combining business, but you are not paying anything for the other one. So it will be very difficult for us to identify the acquirer because you are not paying anything for your dad's business. You are not paying anything to acquire dad's business. So we have the merger, we have the takeover, and we have the issue of inheritance that can make it very difficult for us to identify the acquirer. Okay, to identify the acquirer. So identification of the acquirer, we have to identify who the acquirer is. That the acquisition, is it presenting acquirer or is just It's just exchange of assets. What are we doing? Are they actually paying for the net assets or we are just merging? Or you should be able to identify the acquirer. If you're not able to identify acquirer, you cannot account for this particular transaction as a business combination under the principles of the IFRS 10 and also the IFRS 3. You cannot present goodwill. Okay, you cannot present goodwill. You cannot recognize goodwill because you are not paying anything. Goodwill is actually the acquisition premium. Okay, how much? What is the value of the asset that we are buying? How much are we paying for it? Okay, the difference over there is that we are paying for something that cannot be seen. We are paying for the kind of relationship that they have with the customer, which they fail to recognize in their books because they cannot separate the relationship from the normal business activities that they are doing. We are paying for their strategic location, but they fail to recognize that because the amount that we are paying for the land and the amount that we are paying for the location cannot be separated. So we are just buying the land. So how can we say that the location itself, the value of the location can be separated from the land? No, we are buying for everything in the land. Okay, so that particular value of the location cannot be measured reliably. Okay, that is the reason why we don't recognize internally generated goodwill, because the value cannot be measured reliably. The value cannot be measured reliably. If you are buying phone and they are giving you remote, how do you measure the value of the phone and the value of the remote? So you can see that the amount or the value of the remote cannot be measured reliably, cannot be separated from the value of the phone. You are giving that because of the phone, so the cost cannot be measured reliably. That's why we don't recognize intangible assets. Okay, that is going to be internally generated. So if you are not doing, if it is not acquisition, you cannot recognize goodwill because you're not paying for anything. Okay. Let's also identify the acquisition date. Acquisition date, we want to identify when was the acquisition done? Okay, when was the acquisition done? Is that giving us control? Is that giving us control? If that is giving us control, we start consolidating from that particular date. Sometimes acquisition can be achieved in stages. That is the advanced issue, which we are going to be looking at. We are coming to identification and measurement of the liability and then the assets. At the date of acquisition, we need to identify the asset of the what? Of the investee, and we also have to measure it. Okay, this is going to be very simple. The measurement is going to be very simple. Okay, we are going to be looking at certain items that the measurement principle will not apply to. Okay, at the date of acquisition, all the assets and liabilities of the subsidiary or the investee should be measured at fair value. Why are we measuring this at fair value? It's just like those people, they are disposing their asset of. They want to dispose their asset of. Okay, if you have an asset, okay, so if you have an asset that you are using for your business, okay, and they are saying that the carrying value is 20,000, okay, and they are saying that the market value in the market value is 25,000. Okay. At which of these amount that you are going to be selling the item? Are you going to be selling that at the value in your books, or you are going to be selling it at the market value?
At market value.
Okay, at market value. So what will happen is that this is just like a business valuation. The owners of that particular company are selling off their portion. They are selling off their 70%. So what they have to do is that they have to determine the current value of their shareholding before they sell. So the fair value measurement is just like what? They are valuing the business before they sell. So if you are valuing the business, it means that you have to now value the business to their market value. So the asset that you have, what is the value of the asset in the market now? So if you want to sell it, you sell it at the current market value. If the market value is 15,000, people will not be willing to buy the 20,000. No. Because they will say that in the market, this is the, so you have to sell it at the market value. And that is the reason why all assets and liabilities must be valued at what? At fair value, at the date of acquisition. So all assets, the measurement over here, okay, the measurement principle is that at acquisition, all assets, okay, but we have some assets that we have some exceptions to this particular measurement. We'll be looking at that. So all assets and liabilities must be measured as what? Must be measured at fair value. So at the date of acquisition, they must be measured at fair value. So at the date of acquisition, since the owners want to sell that one, they will value the company. Mostly we use the net asset method. So they will value the company to the current market value before they will dispose it. So that's why we fair value it, just like a business combination using the net asset method. So you have to, before you have to sell something, you have to know how much the thing costs now before you sell it. How much the thing costs now before you sell it. Okay, so all of these must be fair value. Okay, what are the exceptions? Okay, we have the exceptions to this fair value measurement. Okay, there are certain assets and liabilities that will be arising at the date of acquisition. Example can be a contingent asset or a contingent liability. Okay, so asset or liability arising from contingent, okay, that are going to be a contingent asset. Okay, that are going to be contingent liabilities. So at acquisition date, any contingent liability and contingent assets must be measured using the applicable standard. Which standard is relating to the contingent assets and contingent liabilities?
IS 37.
I said so.
Okay, must be measured. Okay, so if there's any contingent liability over there, before you can recognize it as part of the asset or liabilities, you have to now make provisions, or that particular asset must meet the recognition criteria of what? Of the liability on asset under the IS 37. So must be measured in line with what? IS what? 37. Okay, so these are any contingent liability and asset. You have to use the principle of what? IS 37 to measure it. Okay, so we use this particular one. Okay, at the acquisition date, there can be an issue of non-current asset held for sale. So the question can be telling you that at the acquisition date, the entity has made a decision to classify an asset as held for sale, and they will give you some information over there, which was last sitting question, part of the footnote for what? For the corporate reporting people. Any issue about non-current assets for sale. So at the acquisition date, there can be an issue of non-current asset held for sale. This must be measured in line with what? IFRS what? IFRS 5. So if the acquisition date there is any issue of non-current asset held for sale, the measurement must be based on what? The principles or the provisions of IFRS 5. How do we do that? You determine the fair value, which will be the fair value less cost to store, and you determine the carrying value. You now test for impairment on that particular asset. If there's any impairment, you write it down to the lower value. If there's no impairment, you carry it at what? At the carrying value. Okay, you carried it at what? At the carrying value. So if there is any issue about non-current asset held for sale, that particular one must be measured in line with what? In line with the non-current asset held for sale, where the asset will be carried at what? Lower of the carrying value or the net realizable value, taking into consideration the measurement what principle that the entity is using, whether they are using revaluation model or they are using what? Cost model. Whether they are using revaluation model or they are using a cost model over there. Okay. Another one is we call something. Okay. There can also be an issue of employees' benefits. Okay. There can also be an issue of employees' benefits. Okay. Basically, some of these will appear for corporate reporting, some of these will appear for financial reporting. If there is issue of any employees' benefit, the recognition should be in line with you apply the what? The applicable standard to determine the value that you are going to be recognizing at that particular date, or the value that you are not going to be recognizing. So as acquisition date, the subsidiary can now implement what? An employees' benefit scheme. Okay. You have to use the recognition criteria, or you have to use the measurement basis of the IS 29 to account for that. We can also have what we call the share-based payments. So there can be a share-based payment arrangement. So a share-based payment arrangement at that date. That particular share-based payment should be done. The recognition should be based on what? IFRS 2. So at that particular date, the parents can now say that, okay, the share base that the subsidiary is having, they are going to be settling it. Okay, they are going to be settling it. How are they going to be settling it? Is there going to be a cash option, or they are going to be giving share appreciation rights? So the recognition should be based on what? The share-based payment. Okay, the principles of share-based payment. We also have what we call the indemnified asset. Okay, what do we call the indemnified asset? So we call something in principles of insurance, we call something indemnity, where they are going to be compensating you for any loss that you have what? You have incurred as a result of what? Your insurable interest, the asset that you have insured. Okay. There can be a situation where the question will tell you that, okay, the holding that has been given out, or the payment that has been done, if the entity is not able to meet this particular profit target, this amount of what? The money will be what? This amount of the consideration will be what? Will be returned. Okay, this amount of the consideration will be returned. So we call something the indemnified okay, the indemnification asset or indemnified asset. Okay, this one is a form of compensation that either the parent or the subsidiary will be what will be given to the parent. It can be from any of them. Okay, and this indemnified asset may be based on a particular condition or particular asset. Okay, if it is based on a particular asset, then the measurement of the indemnified asset must be based on that particular one. If it is based on a performance obligation, that, okay, if you're able to achieve a profit of this amount, we are going to be giving you this. If you want to recognize that at acquisition date, you have to now base, okay, what is the profit level now? What will be the change in the profit? So if there's a change in the profit at this amount, then what should have been the amount that we should recognize now? Okay, if they say that if you are not able to achieve this particular profit target, you are going to be paying 4,000 of the consideration given back to you. And the question is saying that, okay, the fair value of that particular asset is now this amount. So you have to recognize that particular 4,000 now. Going forward, the amount that they will be refunding might be increasing based on their bad performance. So you measure it based on that particular one. But before you have to recognize this particular indemnified asset, you have to make sure that it is probable that this particular refund will be done. Okay, you don't just have to recognize it. Are the people going to pay? Are the people not going to meet the condition attached to this particular one? If that is the case, if it is probable that they are going to be paying it, and it's probable that they are not going to be meeting the condition attached, then you can recognize the indemnified assets. Apart from that, nothing should be recognized for this particular one. We also have what we call reacquired what? Okay, these are the exemptions to this particular measurement principle. Okay, we also call something reacquired what? Assets. Okay, reacquired assets. What do we mean by reacquired assets? Okay, you can see that most of the companies in Ghana over here, most of them that you are going to be seeing, the KFC at the top of them, what are they using? Are those companies owned by the KFC people, the KFC group, or they are owned by what? The indigenous people?
They are owned by the indigenous people.
But what are they using? They are using something. They are using an
Franchise.
agreement. Okay, they are using franchise, isn't it?
Franchise.
Okay. The KFC itself can decide to acquire any of those people. Okay. If the KFC is acquiring those people, they can see that they are now acquiring their franchise rights, isn't it? Okay. Their franchise right is still with the people, and they're now acquiring those people. Let's say the KFC Ghana, any of them. Okay. Any of them, the franchise. Okay, they are going to be acquiring this for a particular period. So they are going to be what? They are going to be recognizing that as an intangible asset. Okay. If the KFC is now acquiring these people, it means that they are now going to be acquiring their what? Their franchise right again. That's what we call a reacquired what? Asset. The reacquired asset. So the reacquired asset, what you have to do is that you ask yourself, how much are you paying for it? Okay, are you paying for this particular franchise right again? Are you paying for it? If you are paying for it, fine. If you are not paying for it, then it means that it should not be part of what? It should not be part of the net asset if you are determining what? The goodwill, because you are not paying anything. Okay, so the franchise rights, what you have to do is that, do you still have what? Do we still have some contract left if the people are taking this for 10 years? They have used it for 6 years, and we have now acquired back. Are we paying something for it? Yes. If we are paying something for it, it means that we are paying something for that one, which will be used over what? Over the remaining 4 years. So we are compensating the people for the remaining 4 years that they have on the what? They have on the contract. If you are paying something for it, the amount that you are paying over there should be the what? Should be the one that should be recognized in your what? In your purchase what? Acquisition. But if you are not paying anything for it, please, the franchise rights cannot be part of the net assets of the what? Of the subsidiary. It cannot be part, because we are not paying anything for that particular one. So there is no part of the consideration that is what? That is going to be for the franchise right. So we cannot include it in the net assets calculation. But if you are paying something for it, it means that that particular amount that we are paying is making the franchise rights to also be part of the net asset that we are paying. Okay, so the reacquired rights, the reacquired assets, or the reacquired right, or whatever will be the case, you have to actually determine whether the reacquired right is part of the business that you are acquiring, or it's not part, or it's something that you are paying these people back to take the money, or you are giving them the money back to them to what? To take your rights back. Whatever be the case, you have to reassess that. If you are paying for it, then the amount that you are paying will be amortized over the remaining what? The remaining life of the franchise, because that is now will be for the company itself. So you pay and what? You amortize that over the what? Over the remaining one. So this is basically about exemptions to what? To the measurement principle. Okay, aside this, all assets and liabilities must be what? Must be remeasured. Let me pick particular example over here so that we determine how this can be determined. Let me check this one. I'm sure I have a question where that particular one is part. Okay, so let me see. Okay, let's come to this one. Okay, Auntie Vic, read this one for us.
Please, you are not sharing.
I'm not sharing, sorry. Uh, Auntie Vic, read the fair value of property, plant, and equipment that Aguna at acquisition had made a decision to.
Okay. The fair value property, plant, and equipment that Aguna at acquisition had made the decision to sell, which did not change despite the acquisition, was 35 million cedis. But the historical cost carrying value was 15 million cedis. The estimated selling cost of the assets on this date was 1 million cedis. The asset was yet to be sold as at 30th June 2022, and the above Agones financial statement is yet to reflect the decision to sell the assets and any fair value adjustments. The group follows cost model for subsequent measurement of all property, plant, and equipment. Should I continue with the C?
No. That I'm talking about all in that one.
Okay.
Okay. What are we going to be using for that? How do we determine the value at acquisition?
So I think that's 5 million.
It should be
That's 5 million.
35.
Million.
How shall I?
Yeah, because that's the fair value at the date of the acquisition.
What are they saying there? What is happening there?
It didn't change despite the acquisition.
It's not that is not the issue right here. Had made a decision to do what? It's a fair value of property, plant, and equipment that Aguna at acquisition had made a decision to sell, we did not change despite acquisition was 35 million, but the historical cost carrying value was what, 15 million. The estimated selling cost of the asset on this date was 1 million. The asset was yet to be sold as at what 30th June, and the above Agona's financial statement is here to reflect the decision to sell the asset and any fair value adjustment. The group follows cost model for subsequent measurement of all property, plant, and equipment. So what will be the amount that we are going to be picking?
So is it 14 million?
Now look at it again very well.
34 million. Hello.
Yeah, Senior, I'm with you.
So I'm saying because of the estimated cost in it, we are deducting it from the fair value 35 million to making it 34 million.
This is non-current asset. This is asset held for sale, isn't it?
Yes, please.
Yes, please.
How do we measure asset held for sale?
The law of carrying out
Of course.
and the fair
Okay.
value.
The lower of what?
Of the carrying amount.
Okay.
And the fair value less cost to sell.
The value.
Okay. So the question now is, why are you people picking the 34 or the 35 million?
Right.
Because I'm waiting for a response. Why are you picking the 34 million and those ones?
And so it's 15 million.
Is what?
15.
15.
Yes.
So we are not settling on a 15.
Sure.
Yeah.
Yeah.
Okay, please. That you see, this they have given this footnote to what? To corporate reporting people last sitting. It was part of the footnote. Okay. I have this question that they have been picking some of the footnotes. So they have picked two from this one. Okay. This one, they have picked two from this one. You see, that particular footnote is just given to you for nothing. Okay. That particular footnote is just given to you for what? For nothing. Okay. It's not going to be changing anything. It's not going to be changing anything. Okay. So it means that they still have the value in their what? They still have the value in their books will be what? Will be 50 million. Okay. You don't have to come to fair value because we say that all assets and liability are following what? Are following the fair value measurement, except what? Asset classified as held for sale. Okay. Another exception which I didn't add. Okay, is income
Hello,
tax.
sir.
Yes, Senior.
So now that that footnote usually being given, do we show workings to it or we ignore it?
There is no working. You do workings to footnote that are requiring workings. There's no workings to that one, so you ignore.
Okay.
Okay. So another exception is what? Is income tax. So sometimes there will be an issue of deferred tax. So the question will tell you that the increase in the fair value adjustment will be given a rise to deferred tax or something. So if there's any issue of deferred tax, you also, or the income tax, you also do that. Okay. So this particular footnote, one of a footnote like this has appeared in the corporate reporting group account last sitting. And if you check, I'm sure that if you check the solution, there will not be any entry about that one. So it means that you have wasted your time to think about this and also adjust it. Okay, that is how wicked an African can be. Okay, why will you give me a footnote that will not do anything? Okay, but it's part of the exam. It's part of the understanding of the issues. So this will still be classified as what? As the lower of the cost. Unless the question is saying that, look at this. Unless the question is saying that the group follows what? The group follows what? They say the group follow cost model. So unless they are saying that revaluation model, okay, unless they are saying that they are using revaluation model for subsequent measurement of what? Property, plant, and equipment. Okay, unless they are saying that they are using the subsequent for property, plant, and equipment. If they are using subsequent, what will happen is that after this one, any subsequent issue that will come in, we'll be having what? The revaluation model. Or they are saying that the subsidiary follows what? A revaluation model for accounting for each property, plant, and equipment. At that particular date, we have to fair value before we classify. That is the only time that you can pick the 35 and subtract the 1 from it to get it at the amount. Okay. But for this particular one, they are using cost model and you cannot do anything about that particular one. Okay. You cannot do anything about that particular one. Okay. Let me talk about what we call measurement period. Okay. We are saying that all assets and liability. Okay, I will talk about that one when we are looking at determination of goodwill. Okay, let's now enter into the IFRS 10 itself, which is consolidated financial statements. Consolidated financial statements. So they can ask you, financial reporting people, what is a consolidated financial statement? They can ask you, okay, consolidated financial statements. Consolidated financial statement, we are just saying that we are presenting a financial statement for 2 or more entities as if they are a single what, economic entity. So we are going to put 2 companies together as one. That's what we call the consolidated financial statement, group account. We consolidate the items now. Consolidation will be done when you have control. Okay. As soon as you have control, you have to consolidate from the time of what? Obtaining the control. Okay. So what it means is that consolidating means is that if you have the asset of A and you have the asset of B, okay, if A is having control over this one, the assets of A and B will be put together. We do the consolidation line by line. We add the item line by line forward for all these what? All these the companies. So the one that you're having control, if the asset for this one is 20,000, you add 20,000 plus 5,000. So you put their financial statement together as if it's just one statement. Okay, it's just a one statement. That is what we call the consolidated financial statement. Okay, we have situations where a company will have control, but a company will not be allowed to consolidate the other company. Okay, where can we have a situation like this? Okay, where can we have a situation like this? Let's come here. A is the owner. Okay, let me say that the A owns B, but B owns C. Okay, can B be able to consolidate C?
No, please.
Okay.
No.
Okay. So you can see that B itself will be consolidated, isn't it?
Yeah.
Yes, please.
Yes.
Okay. B itself will be consolidated. Okay. This is where we have the complex group structure. Okay. B itself will be consolidated. So we can see that the B itself will be B and C. If B wants to prepare a consolidated financial statement, it will be B and C, isn't it? Okay. So if A now want to consolidate this one, then it means that A is going to be consolidating the B as a group. So that will be A, B, C. So A will now be the one that will prepare financial statement because A is the what? Is the ultimate owner of the two. Okay. So B itself is a subsidiary of what? Of another company. So B will be consolidated. B cannot consolidate C. But what will happen is that if B, assuming B wants to prepare a consolidated financial statement, it will be B and C together, isn't it?
Yes,
Okay.
please.
If A want to consolidate B now, then A will consolidate the B and then the C together because the B and C is the what? Is the B itself. So consolidating B now means that you have to consolidate the B together with what? Together with the C. So you can see that A will be preparing a consolidated financial statement for for A, B, and C. So it means that B cannot consolidate itself. Okay. So one of the exception is that if the subsidiary itself, okay, if the subsidiary itself is what? Is a partially owned or a wholly owned what? Subsidiary of a what? Of a different what? Of a different or of another entity. So these are the exceptions for preparing group accounts. Okay, if you have control, you can prepare group accounts. Exceptions as to there's exception as to when entity will have control, but they cannot prepare a group account. The first one is what I've demonstrated. The parent itself is a wholly owned subsidiary or is a partially owned subsidiary of another entity. This is the situation where we have what we call the complex group structure. So the another entity, which is the A in this particular situation, A will now what? A will now do the consolidation for B. So A will now consolidate the B together with the company that B is what? B is having control over. So do we now have the complex group structure over there? If securities are not publicly what? Traded. What do you mean by if securities are not publicly traded?
It's not
They are not
listed.
a listed
Not
company.
listed, thank you.
Okay, so preparation of group accounts is not a requirement for companies that are not listed. It's not a requirement for companies that are not listed. If you like, you can prepare. If you don't like, that is fine. Okay, so if you like, you can prepare the group accounts. If you don't like, that is fine. Okay, so the preparation of group accounts is a major requirement for what? For only public what? Companies that are listed. Okay, it is not in the process of issuing securities in public what? Security market. Okay, so it's the same as what the first point and this one is still they seem to be the same. Okay, so they are saying that you are not in the process of what issuing securities in the public what security market. It's just like you are, if you want to get listed, okay, if you want to get listed, you'll be required to prepare group accounts. Okay, so if you are in the process of getting listed, you'll be required to prepare a group account because very soon you'll be listed on the stock exchange market. People are interested in your what? In your item. So you have to combine all your companies and prepare. But if you're not in the process of that one, it just means that you are not listed. Okay, it just means that you are not listed. But if you are in the process of getting listed, then you can prepare. If you are not listed at all, you can't prepare. But what if you are in the process of getting listed? You can prepare. But if you're not in the process itself, it means that you are not listed. So you cannot prepare that one also. Okay. The ultimate or the intermediate parent publishes what? A consolidated financial statement that comply with what? International financial reporting what? Standards. The ultimate or intermediate parent prepares what? Publish consolidated financial statement that comply with what? The international financial reporting standard. So I've said that there can be a joint control. Okay, there can be a joint control. If there's a joint control, they can actually ask you to what? They can actually appoint one of the companies to prepare the consolidated financial statement. If that one is being prepared, there's no way you also have to consolidate what? The other subsidiary again. So issue of joint control. Okay, when the intermediate or the ultimate parent publish consolidated financial statement that will comply with international financial reporting standard, that we have 50-50. Okay, why will you be consolidating the same subsidiary? Different person will also be consolidating the same subsidiary. No. Okay, so if one of them choose to consolidate, the other one who is having control, 50-50, that person cannot consolidate again. Okay, that is what they are trying to talk about over here. Let's use the 7 minutes to talk about another issues. Then we come back to other one. So the introduction, we are going to be using only 2 meetings for the introduction. Then we pick questions. Okay, we are saying that. Okay, we are saying that for the purpose of our discussion, for the purpose of our business combination, we are talking about those combinations that are arising from what? From acquisition, isn't it?
Yes, yes.
Okay. If we are saying acquisition, it means that you are paying something for the for the equity shares that you are buying, isn't it? Okay.
That's right.
What are
Yeah.
the forms that you can actually finance that particular transaction? So you'll be looking at, okay, how do you pay for the equity shares? How do you acquire them? That's what we are going to be looking at right now. How do you acquire those things now? Okay, so you'll be looking at what we call consideration. Consideration is the amount that you are paying in return for what? For the equity shares. Okay, so the amount that you are paying. So let's come to consideration here. Okay, people call it purchase consideration. Some people call it cost of investment. Anyhow you are calling it, it depends on where you have obtained your knowledge on business combination from. Okay, so we have purchase consideration. The purchase consideration is the amount that you are paying or giving in return for what? For the portion of the asset or for the portion of the equity shares that you are buying. Okay, we are saying that we should pay for the shares. So if you are buying 70% of the shares, okay, you should pay for it. How do you pay for this? That's what we are coming to look at. So we're looking at forms of consideration. Forms of consideration. Okay, forms of consideration. Okay, if you want to buy something from someone, how do you pay for the thing? What are the means or the forms that you can use to pay for that particular item that you are purchasing?
Cash.
Okay, so you can pay cash where you are going to be paying immediate cash. So you have cash consideration. Okay, you'll be having cash consideration over there where you are going to be paying immediate cash for what? You can pay immediate cash for that particular one. Okay, you are paying immediate cash for that particular one. If you don't have cash, what are you going to be doing?
You defer the payment.
Okay, so you can tell the person that I don't have cash to pay you now. Okay, I don't have cash to pay you now. But what will happen is that I'll pay you, but I'll pay you in 2 years' time. Although you are going to be paying the cash, but you're not going to be paying the immediate cash. You pay the cash at a later date. Okay, but the question is, if you should have the money and pay now. Okay, that is the question. You have 70%, and you are saying that you are going to be paying 200 million in what? In 2 years' time. Okay, in 2 years' time. That is 200 million in 2 years' time. The question is, if you should have money now, will you be paying the 200 million now?
No.
If you have money now, will you be paying the 200 million for whatever you are buying?
No.
No. Okay, so there will always be the amount that you should pay now, which is a principal. Okay, so the amount that you should pay now, which is a cash price. If you should have cash, you are not going to be paying 200 million. But since you are holding the person should have used that money to do other investment. But since you are holding on to that particular amount of money, the person will now calculate the return that we'll be getting on the investment if you should give him cash now. And the person will add it to the amount that you're supposed to pay. Then you pay the two. So it's just like okay. So it's just like you are owing me 2,000 Ghana cedis. If you give me the 2,000 Ghana cedis right now, I'll buy 10 bags of cement. But you are saying that you don't have the 2,000 now. You pay me at the end of the year. What will happen is that at the end of the year, will the 2,000 be able to buy the same 10 bags of cement? No, it can only buy 8. Now I need 2,500. So if you want to pay, if you want me to grant that particular, or if you want me to accept that particular situation of paying at the end of the month, you have to accept that you pay the amount that can purchase 10 bags of cement that I want to purchase with the 2,000 today. I have factored in what we call time value of money. So if you count the deferred consideration will always come with what? With an interest component or what we call a financing component. You don't have the money now. Okay, but you say that you pay in the future. You are paying in the future. The assumption is that the person, a rational being, cannot say that you're supposed to pay me 200 million now, and in 2 years' time you should pay the same 200 million. No, a rational person cannot do that. So what it means is that the money that you're supposed to pay, Okay, the principal that you're supposed to pay today has been what? Has been added to the interest that you are going to be what? The person would have been getting on an investment if you give the money to the person today. So what we do is that we try to separate the what? The amount that you should have paid. What? The amount that you are actually paying for the what? The shares. That is what, let me put it like that. The amount that you are actually paying for the shares and the interest that you are paying. So we separate the two. How do we separate the two? Okay, the question will give you the cost of capital of the parents. So the question will give you the cost of capital. So let's say they can give you a cost of capital of what? Of 10%. So this just means that a certain amount invested at 10% for 2 years will give us what? 200 Ghana cedis. A certain amount invested for 2 years will give us what? 200 Ghana cedis. How do we find that particular amount? So if the principal is that amount, we know that the principal plus the 2 years interest will give us this one. This is going to be a compound interest. We assume that you are not paying the interest until the end of what 2 years that you pay the full amount. So the interest and then the principal is what is being reinvested. So we are going to be rolling over. Okay, how do we find this one? We know that if the amount is 10%, the first year we are going to be having our principal of 100% plus the interest of 10% of the principal. So what we do is that the first year amount will be 1.1. Why 1.1? We have added the interest to this one. Okay. Second year, the interest will be what? Will be charged on this amount. So this will be our 1.1 over here plus another 10%. Okay. Which will be the 10% of that one. Okay. How do we go about that? That will now be plus another 10% of the 1.1 of that particular amount. So if you put the two together, you'll be having so many things. What do we have? This is what we do. We say that, okay, the amount in the first year will be 1.1, okay, multiplied by the amount that we are investing. So the amount for the first year will be 1.1 multiplied by the amount that we are investing. Because if it is 200, the amount that you are going to be having at the end of the year will be 200 plus the interest that you are earning of 20. That will be 220. This 220 can be calculated as 1.1 multiplied by 200. Okay, you'll be having your 220. So you are finding the amount straightforward. The next year, this will be multiplied by 0.2. So you'll be having 22. 22 plus 220 now. That will give you your amount at the end of the second year, which can also be calculated as 1.1 multiplied by 220. So what we do is that it will be 1.1 multiplied by the amount in the same year. That will also be 1.1 again. So you can see that 1.1 multiplied by 200 plus another 1.1. Okay, 1.1 multiplied by the amount that we are investing will give us 200. Okay, so we have 1.1 squared times R multiplied by 200. We are looking for the amount that we are investing, which is the principal. Okay, we are looking for the principal. So you have the amount that you are receiving in 2 years time, which is the future value, divided by 1.1 exponent 2. How do we present value this? Okay, very simple exercise. Okay, how do we present value this particular value? So the deferred consideration at the date of acquisition, what do we have to do? Okay, at the date of acquisition, okay, at the date of acquisition, what you have to do is that you find the actual cash, okay, actual cash that should have been paid. The actual cash that you are paying, that's the amount that you are going to be paying. There is an interest element there. Interest element does not relate to what? The interest element does not relate to the amount that we are paying. What is the actual amount that we are paying? You find the actual amount by finding what we call the present value. That will be calculated as a future value, which is the amount that you are going to be paying in the future, divided by 1 plus R. You can see that we have done 1.1 exponent what? 2. That is 2 years. So 1 plus R divided by what? The N. Okay, the N over here is the what? Is the number of years that it will take you to what? To pay this. Future value is the amount that you are paying in the future. The R is the cost of capital, the interest rate, which I have done over here to be 200 divided by 1.1 exponent what? The 2. So the arrow over here is the 10%. The 200 is the 200 that I'm paying in 2 years' time. And the 2 is the what? Is the 2 years. I'll be paying this in 2 years' time. So you find your actual what? The actual cash that you are paying. So let's assume that the actual cash that we are going to be paying, if we should have money now, we are going to be paying 150 for the what? For the shares. So this will be our purchase consideration. This will be the 150 that we have, and that will be the cost of investment, or that will be the investment that the parent will be recognizing in its books as investment in the subsidiary. So this is the amount that we are paying. But are we paying this amount now? Are we paying now? Okay. Are we giving the 150
No,
to them
please.
now?
No, in 2 years time.
So it means
No,
that we
please.
are currently owing them, isn't it?
Yes.
So initial recognition. So initial, at the date of acquisition, what you do is that after doing this, you will now debit your investment, which will always go to the purchase consideration. Then you credit what? Deferred consideration as a liability. Okay, deferred consideration as a liability, which will be 150. Okay, what is the interest component now? We are paying 200 and the actual amount that should have been paid is 50. What is the interest that we are paying for delaying the payments?
50.
Okay,
50.
so that interest will be paid over 2 years, isn't it? Okay, so it means that the
Yeah.
first year, what will happen? So the subsequent measurement for this one. Okay, what will happen is that if we have done 1 year, it means that we should have paid interest for 1 year, isn't it? So you
Yes.
debit either profit or loss depending on what you are doing, profit or loss, or return earnings, which will be the group return earnings. Okay, group return earnings with the interest for the first year, which will be 25 million, isn't it? Would the interest be 25 million?
Yes. Yes.
Okay, what will be the corresponding entry? We're supposed to pay the interest, but we haven't
You-
paid. It will be increasing our 150, isn't it?
Yes.
So you credit your deferred consideration. The interest is supposed to be paid, but it hasn't been paid. So what we do is that you now add it to the deferred consideration to have 175, so that at the end of the second year you add another 25. Then you have what? You're supposed to be paying 200, but the actual cash that you should have paid, if you have money, is 150, but you haven't paid, you are owing. So we have the 150 as owings. You have to pay interest of 25 on that. You haven't paid the interest. If you like, you can treat the interest as what? As a current liability. Current liability rather. Okay, as a current liability. Okay, you can treat the interest as a separate item and the deferred consideration as a separate item. But what we do is that the interest is coming as a result of the deferred consideration. So just add the interest to what? To the deferred consideration. So this is how we account for this one. But for now, we are going to end it over here. Then we continue with what? With the other ones. Same time next week. Then we pick questions. Then we now go back to our normal classes. Okay. Any issue? Any
Hello,
issue?
sir.
Yes, please.
The purchase consideration, is it just the two ways that we can pay?
No, please.
Okay.
All right. So that is it for now. Have a good day. I will see you guys at the appropriate time. All right.